Good morning. So this is for October 8th on Thursday, and this is over section 4E. In this first video, I'm just going to get it started, and this will get us about halfway through the homework. I was afraid of watching a long video might be overwhelming. So in 4E, in this section, we're learning about how to calculate taxes and understand tax deductions. So a few vocabulary words. To calculate taxable income, first you find a person's gross income. And I'll define that in just a minute. Gross income is really everything that they are bringing in. And then you'll subtract, so this is the equation that you use repeatedly in this assignment. You will subtract any adjustments to income, and that will find their adjusted gross income. So that's so these three things are the three things that you'll be talking about in this homework. First of all, gross income is the sum of all of the income a person is receiving in a year. So that should include, in the word problems, any wages, tips, profits from a business, interest from savings accounts, or dividends from investments. So gross income is what you count on bringing in for maybe each month or each paycheck. So including these things. So gross income is all that you're bringing in for making your budget. You can think back to an old section. Adjusted gross income is when you take that income, the gross income, and you subtract contributions towards retirement or any other tax deferred savings plans. So gross income, so this is another idea that you'll see in this homework, and it's just your gross income minus individual retirement accounts or savings plans, tax-deferred savings plans. Okay, so those are two formulas already. And then third here, we have taxable income. This is the adjusted gross income minus exemptions and deductions. That's what you'd pay taxes on. So three equations, and these are written in sentence form. So gross income is everything, you just add up everything that they're bringing in. Adjusted gross income, you take the gross income and subtract retirement contributions. And for taxable income, you take the one before it, adjusted gross income, and subtract exemptions and deductions. Pause this video until you have those three things written down. You definitely want that for this whole assignment. You do this repeatedly and you'll need to know this vocabulary. This is one of the first examples in this assignment. So suppose that you earn wages, or a person earns wages of $45,000, that would be in a year, and they also receive that year $325 from interest in some types of a savings account. That person over that time paid to their retirement plan $2,250, and that person, when they started to do their taxes, they were entitled to a personal exemption of $3,300. They also had deductions. I made this for a teacher. Teachers always can get up to $250 in deductions. So this is what this person might have to consider when they go to do their taxes before April 15th. And to use those three vocabulary words, the gross income would be their wages plus that interest. This is really set up exactly for a teacher, a school teacher right here. So this would be what we'd consider their gross income. Their adjusted gross income would be that amount minus what they put towards their retirement, so $2,250. And that is how I got this value. I would suggest having a calculator and go ahead and find the gross income minus the contributions to the retirement to find the adjusted gross income. And for taxable income, that is when we take adjusted gross income and subtract deductions and exemptions. So subtracting the $3,300 and subtracting the $250 from adjusted gross income gives us this value, $39,525, and that would be the teacher's taxable income. You will do several examples like this, so you want to make sure you understand those three concepts, and I thought this table might help, so you might write down an example like this for later. Now, on some of the questions, I think there's one question where you're asked if the person should itemize or not itemize, doesn't need to itemize. So this is a question that everyone must consider when they're doing their taxes. When you're completing your taxes, there are automatic deductions. So taxpayers have a chart, and it looks something kind of like this. This was just one I pulled offline, but this shows you, this was to emphasize comparisons between 2017 and 2019, because every year the deductions change, the tables change somewhat, especially when you have different leadership in legislation. So, okay, 2017, these were some standard deductions, and then in 2019, these were some standard deductions. So I just wanted to kind of give you an idea of, really, it's a long table that you'll see when you do your taxes if you do them by hand, and you have to look up your deduction. And so this is an example. In your homework, you're going to see some similar tables, and this is what they're trying to mimic there. If you would prefer to itemize. So some people itemize, some taxpayers, especially if you go to an accountant, you might be more likely to itemize your deductions. Now, when you do that, it's honestly not usually a teacher. This would be if you own your own business. It's often better. Real estate, they often itemize because they get deductions for driving people around. So you can kind of talk to family and ask if they itemize or not. When you itemize, you have to do a lot more paperwork, but you might be able to deduct more money from your taxable income. So that's going to cause you to not have to pay as much in taxes, and so that's why that's a benefit. So the choice is to itemize or to not itemize. In the question in your homework, you're going to have to compare the standard deduction to what they would have if they were to itemize their deductions. Often, and I'd say definitely in my experience, often it's just best to take the standard deduction rather than itemize, because it's usually either very, very close or the standard deduction is greater than that. I wanted to show you this because I thought that part of this was a little bit tricky. So in this problem, you're going to get this table like what I was showing you before, and then you'll have a person. So this is a single man, he earns wages, and then gives you some information. I want you to notice, so for gross income, by the gross income, remember, is all of the money that he is bringing in. So you're going to take the earned wages, 61,400, and add that to the 400, and that is how I got my 61,800. So $61,800. The next part that I have here is the adjusted gross income. Now recall from my previous slide, adjusted gross income is the gross income minus tax deferred, any tax deferred retirement savings. So you're going to take what we had before and subtract 480, and that is how I got 61,320. When I get down here, I have a question. Should he use the standard deduction or itemized deductions when finding his taxable income? It shows you that he had $3,270 in itemized deductions from contributions. So he donated to some charities, and you're able to deduct that on your taxes. Now, based on the table, we notice that everyone has a standard deduction of $6,350. So I chose the option he should use the standard deduction, as it would deduct more money from his taxable income. What I was looking at there is I was comparing the $6,350 to the $3,270 that he had from itemized deductions. So you want to compare those two because the standard deduction is greater. That's why I chose that. Now I actually missed this question, so I want to tell you why I missed this question. Taxable income is the adjusted gross income minus standard deductions and exemptions, and I just didn't see this exemption really here. So for your adjusted gross income, you want to take that value, 61,320, and subtract not only the standard deduction, but don't miss that you have exemptions here. So you're going to subtract both of those. If you'll notice, this is $10,400. So subtracting that from the 61,320 gives us 50,920. And that is his taxable income. So that's what he'll be charged tax on. I'm going to stop this video so that these don't get too long, and then on the next video what you're going to have to do is you'll have pretty much the same problem, but you will have to actually calculate the taxes for a person. So once you have their taxable income, you're going to use this table and calculate their taxes. So that's what we'll try in the next video.